Hello and welcome to another Diwali video. Today we're taking an in-depth look at SAP or SAP, however you want to call it. Ticker symbol SAP. We'll dive into the financial metrics, assess the company's growth, and ultimately try to find its fair buy price. SAP SE is a German multinational software company based in Waldorf, Baden-Württemberg, Germany. It develops enterprise software to manage business operation and customer relations. The company is the world's largest enterprise resource planning software vendor. The stock is priced at $240 with a market cap of 269 billion. Now let's dive into some key valuation metrics. The price to earnings ratio stands at 45 and the price to cash flow ratio is 33.4. The median PE over the past 10 years was 27.3. Over the past 5 years, the company's revenue has grown by 11.46% and its bottom line has increased by 112.4%. In terms of earnings per share, there has been a growth of 86.2%, and notably the number of common shares outstanding is 1.18 billion, a minus 1% change over a period. Now let's assess the company's liquidity and solvency. The interest coverage ratio is 13.9, indicating the company's solid ability to handle its debt obligations. The quick ratio, a measure of the company's short-term liquidity, is 1.12, which is very good. And additionally, the long-term debt to equity ratio is 0.17, and the total debt to equity ratio is also 0.17. This shows that they have low short-term debt and that their debt load is very low, at least in comparison to their equity, which in combination with their high interest coverage ratio is very good. So they have a very healthy balance sheet. Shifting to the cash flow statement, cash from operations stands at 7 billion, reflecting a growth of 78.2%. Cash from investing activities is 1 billion with a minus 112.7% change, while financing activities are at minus 8.5 billion, showing a minus 7.6% change over the same period. Capex has decreased by 5.4%, and free cash flow has grown by 0.1% to 6.7 billion. Moving forward, let's look at the return metrics, how the company is utilizing its resources. The return on equity is 5.3%, which gives us an idea of the profitability relative to shareholders' equity. The return on investment is 7.9%, and the return on assets is 3.3%. Most important of all is the return on invested capital, or ROIC, which stands at 7.2%. Finally, let's find the acceptable buy price. The first method is conducting a discounted cash flow analysis. By using a discount rate of 9%, a revenue growth rate of 6.5% for 10 years, and a perpetuity growth rate of 2%, we get a fair value of $113.4. Secondly, using a multiples valuation of 20 times earnings, operating cash flow, and 25 times free cash flow, we get a fair value of $142.6. Thirdly, the analyst price target is $245.14, and putting it all together, we get an intrinsic value of $167. Using a 15% margin of safety, we arrive at an acceptable buy price of $142, suggesting that the stock at the current level is overvalued. To wrap up my analysis with a short commentary, uh, first of all, I have to rate SAP as a sell, and as for why, it's because I believe that the fact that their growth is slowing down, they are a mature company, they have low ROI, well, not that low, but still pretty low ROIC, in combination with the fact that they're trading at Nvidia level valuations. I think that's why there's a sell. They're not a bad company. In fact, they're a great company, but they're just too expensive at the current price. Now, if you want to ride it out a little bit more, I'm not sure if it will grow, but as you know, the market in the short term, as Warren Buffett said, market in the short term is a voting machine, but in the long term, it's a weighing machine. So, in the long term, these huge valuations will pop, and I believe that SAP will arrive at a more fair, more okay valuation. But for now, I rate it as a sell because I just believe that it's too expensive, and there is really not much that to look at, not too much to look at this company. I mean, there really isn't a huge growth avenue they could take. If they were a tech company, maybe they deserved huge valuations, but in this case, there's nothing to. Give them, well, I think the moats, they have a big moat. They are basically a monopoly in their space, which is mm, something to look at, but it doesn't give them the advantage, the ability to have 40 price to earnings, 45 price to earnings. I think that's a bit too much even for a monopoly. So to end this commentary, I would consider investing it if its price dropped to sub 140 levels. For now, it's a sell for me. But do your own due diligence first. Thank you for watching. If you found this video helpful, please like and subscribe for more deep analysis. See you in the next video. Bye.